Good evening, ladies and gentlemen, and thank you for joining us this evening on a discussion and outlook for global markets and asset classes moving forward, as we are now a month past the U.S. elections. How will U.S. politics influence the markets? More importantly, what are investors' sentiments to those expectations? This discussion will not be limited solely on the U.S. markets, but rather we aim to try to cover most topics pertinent to regional investors as we are entering 2021. Which asset classes appear more or less attractive than others? Which geographies appear to be improving more than others? Where do we see opportunities? More importantly, what the capital flows in the markets are telling us about investor sentiment and appetite for risk. Global central banks have stepped up with historic stimulus packages that are still being rolled out to offset the liquidity squeeze brought on by COVID, and in the face of other mounting challenges as well. But will that be enough to support markets moving forward? Or is it just masking deeply rooted issues hidden within various asset classes, such as the level of valuation in both bond and equity markets? Are we kicking some of our problems down the road, or will this effort be enough to resolve these issues before these QE programs end? Being market participants here in the region and globally, we have to look at the oil markets and the outlook for demand. Again, with the onset of COVID, the demand picture for oil has been destroyed. Will the discovery of a vaccine and eventual distribution be enough to repair the damage done to oil demand, or are we to expect prolonged periods of depressed oil prices? The energy sector as a whole has experienced a historic shrinkage in terms of participation in global equity and other indices. Does this mean that weights can still move lower, or will the sector experience a revival similar to the tech revolution that we are experiencing as we speak? Will it be spearheaded by stronger participation from the alternative energy side? There seems to be a growing trend of regional investors deploying capital to environmental and social governance investments, or ESG as we call it. It was unheard of for investors in the region to start allocating such strategies, given that we're primarily oil exporting economies. But now with a strong need to diversify, we're seeing a growing interest from regional investors to invest in such strategies. Hopefully our panelists can shed some light on this theme and what they have been observing in the form of capital flows from regional investors, and what are the benefits of such strategies as a part of a well-diversified portfolio. Kamco Invest being one of the largest independent asset managers in the region and managing roughly 13 billion in AUM, we aim to not only provide our clients with access to global opportunities, we also try to provide them with the right information that assists them in making informed decisions with regards to their portfolios. More importantly, we also provide them access to best-of-breed opportunities in the global markets, spanning 5 continents and across asset classes. As the director of the third-party solutions department at Kamco Invest, we do specifically that. We open up the horizon of investable opportunities on behalf of our clients. Through the various partnerships and interactions with best-of-breed managers globally, we can deliver a clear message to our clients on what the most important asset managers are doing to navigate the current and upcoming market challenges. More importantly, how they intend to approach various asset classes and how their investors are following suit. We are honored to co-host the discussion this evening. The institution that will be a guest of our discussion tonight is Amundi Asset Management. Amundi is the largest asset manager in Europe by assets under management and the only non-US manager among the top 10 global asset managers listed by AUM. The firm manages approximately 1.9 trillion in assets under management. It is a global investment manager offering its clients a comprehensive and diversified range of solutions across asset classes, markets, regions, and currencies, which can either be actively or passively managed. The firm has been managing mandates for Middle Eastern clients since the 1970s and has had a physical presence in the Middle East for the past 20 years. Amundi is proud today to have over 100 million retail, institutional, and corporate trusted clients worldwide. Founded in 2010 with the merger of French groups Crédit Agricole Asset Management and Société Générale Asset Management, Amundi made product quality, proximity in client relationships, organization efficiency, and responsible engagement its founding pillars. Before we start with introducing our guest, may I kindly note the following. If you have any questions related to the topics that we are covering today, maybe you can ask them in the Q&A section that's listed below your screen. Please feel free to ask, and if we can, maybe we can sneak the questions into the discussion today, or we can reserve it towards the end and we can ask the panel specifically. Introducing our first guest tonight, Mr. Ken Taubes. Ken is the Chief Investment Officer for Amundi US and a portfolio manager at Amundi Pioneer Asset Management. As Chief Investment Officer, Ken oversees US fixed income, equity, and multi-asset teams, including portfolio management, fundamental research, and trading. In addition, Ken leads the day-to-day investment activities of the US fixed income team and is a portfolio manager on a number of fixed income multi-sector portfolios. Ken is the chairman of the US Investment Committee and a member of the US Executive Committee and US Management Committee. He also is a trustee of the Pioneer Funds, which oversee Amundi Pioneer's US registered portfolios. We are also joined by Mr. Connor McCarrick, who is a senior credit analyst and a part of the emerging fixed income corporate strategy team. He's responsible for emerging market energy, emerging market chemicals, ex-Asia, since late 2017. Between 2011 and 2017, Connor worked as a part of the European credit research team, covering a range of both DM and EM sectors, including chemicals, TMT, healthcare, and others. Our third guest tonight is Mr. Lutfi Ben Lesla. Lutfi is the Director of Institutional Clients at Amundi Middle East. Lutfi joined the Amundi Middle East team in Dubai in 2018 as a relationship manager covering institutional, sovereign wealth funds, pension funds, central banks, and corporate clients in the GCC. Last but not least, we are joined by my dear friend and colleague, Mr. Lubomir Krisponovich, or Luba as he's better known in our organization and hallways. Luba is Vice President at our fixed income and at our equity and fixed income department. In his current capacity as head of investment advisory at Kamco Kuwait, he oversees a team of buy-side analysts as well as strategic asset allocation, portfolio structuring, and quantitative research related to regional equities and fixed income. Gentlemen, welcome tonight, and looking forward to the discussion today. Maybe we could start off with you, Ken. One of the topics that have been very popular over the last, let's say 6 months has been the US elections and what would be the possible outcome. And now, 1 month into it, we kind of know what the outcome is with the Biden administration coming into the White House. What do you believe the impact on a Biden administration would be on the markets or policy, or the impact of his policies on markets?
Yes, good evening, everyone, and thank you. And I'm very pleased to be participating in your webinar today. So thank you very much, Faisal. I think that everyone knows the election's over except for one person in the White House, apparently, who still thinks he has a shot at it. But assuming that's going to be in the rearview mirror pretty soon, yes, we're 1 month out. And I think there's a few things that we should consider from the election. Particularly as it relates to the market, of course. One is, I think the market is relieved, despite President Trump's exertions otherwise, that it went better than expected. The physical voting, the mail-in, the outcome, the announcement. So I think the market had a significant relief about that. And there were not and are not significant legal challenges that go all the way to the Supreme Court delaying results. That's number one. Number two, I think the markets also recognize that unusually, President-elect Biden had no coattails. In other words, usually when the winner is the president, if that party has down market coattails, in other words, brings in greater numbers of House members, congressmen, senators, and even governors. But the results are the opposite. The loser, Donald Trump's party, the Republican Party, actually won down ballot, bringing in more members of Congress and also more governors. And I think the result of that, what that is telling us, is that the electorate was a little more nuanced and sophisticated than it often is given credit in the press, in that it wanted a split ticket. It did not want the extreme results from either party. And in this case, particularly, I believe, the extreme policies of the progressive left.
Well, it wasn't a blue wave. So since it's not a blue wave, since we have a mismatched House and Senate, how will that play out moving forward?
Well, there's one hurdle to that, and that is the upcoming runoff elections in Georgia, where there are 2 Senate seats still up for resolution. And of course, the Republicans need to win one of those seats. Otherwise, we will, in fact, have Democrats in control of all three pillars of government if they win both those seats. So then on the table again would be some of those very progressive policies. And remember, if that were the case, Biden's plan and platform, the Democratic plan, was roughly $8 trillion in spending over the next decade against $4 trillion in tax hikes. And frankly, the differential was mostly spent in the first 2 years. That's why the market was not too displeased, I think, at least wouldn't be initially with the Biden platform because of all that fiscal spending. But the long-term implications of that platform are very consequential because it affects not only many industries, but also potential real rates of growth, inflation, et cetera. So right now, I suspect even President-elect Biden is not too displeased with a split Congress, because I think President-elect Biden is far more moderate than his platform suggests. Remember, his platform was written by partly by Bernie Sanders and co. And I think he has historically demonstrated a moderation, an ability to reach across the aisle to negotiate. And frankly, I think he has an easy excuse now not to implement some of the more damaging aspects of that, at least the economic aspects of that platform, because he can blame it on the Republicans in the Senate.
Promises rarely do make policy, I guess. So what can we expect in terms of some of the campaign promises or the expectations of his administration coming into the White House? Will we see the promised tax hikes from 21% to 28%, as was suggested?
Yeah, well, I think there are a few things. One, I think if the Senate remains in Republican hands, tax hikes will be very difficult of that nature because tax hikes have to be passed by Congress. That's statutory. Unlike some other things that he can do without Congress, either through administrative law or through his agencies or executive orders. And you've already seen some of the things that this administration is going to focus on. Clearly, you talked about alternative energy. Climate is going to be one of the top considerations of this administration, whereas
going back into the Paris Climate Accord as one of his priorities and after January 20th.
Precisely. Furthermore, he's nominated John Kerry, the former Secretary of State, to be his climate czar, whatever that means, because that's a new position at the cabinet level. And frankly, that sort of indicates where their focus is going to be. So you might see, for example, you don't need laws or statutes changed to ban fracking or drilling on U.S. federal lands. Of course, you would for private lands. Or you may see him step up the direction and change in direction of the EPA and some of these other federal bureaus to really to enforce environmental law more closely, or to change interpretation of laws to a more climate-friendly sort of outcome. And I think people sometimes underestimate the president's ability to affect policy through these large government agencies and executive orders. Of course, the problem with that is that they're not binding on the next president, so they can last during his term, but a new president can come in and change all of that, and that's what you saw with Donald Trump. In fact, the regulatory burden of the prior Obama administration was estimated to be over $100 billion per annum, and Trump's administration clearly rolled a lot of that back. You can remember during the Obama administration picking up the papers and every other day a new company was being sued or fined for something. We haven't seen much of that in the last 4 years, frankly, much more business friendly.
So all right. So we started off with the topic of taxes and then we moved into ESG. Those two are influences on the market. So if we look at the issue with taxes, if that campaign promise of raising taxes does not make it into policy, that could be a windfall for corporate earnings. Is that a catalyst on why we're seeing markets moving up higher? And do we have that same catalyst, or do we have that same tailwind caused by by Biden's environmental stance?
I think the environmental rules, which will get tighter in my view, and focus will be there, will affect certain industries more than others. So I think that is going to be much more of an industry by industry outcome rather than a broad swath of raising taxes on everybody. So I think that that's an interesting angle there. I do believe, though, that the market has been uh, looking through the near term worsening of the pandemic in the northern hemisphere, frankly, in the US particularly, but also in Europe because of the vaccines. But I also do think the market is very satisfied with the divided government that, as I said earlier, taxes are unlikely to go up in a meaningful way because of the divided Congress. That will be very difficult to pass a big tax hike with if Congress remains divided. There's no appetite for that. And I don't think, frankly, the American electorate voted for a very progressive policy change. I think they voted out Donald Trump rather than his policies, to be honest.
Okay, and in terms of the markets and where we are right now, in terms of valuations, for us here in Kuwait, all we see is the headline news on records being broken on almost on a daily basis in terms of performance. And this has been happening for over the last 4 years, I would guess, since 2016. Are we going to see a continuation on that? Are the drivers, are the catalysts available there in the market to see a continuation on that? And what would be the impact of a Biden administration on those catalysts?
Well, frankly, despite the fact that most financial asset classes are very expensive, I think it's hard to argue otherwise. It will continue for a while, in my view. Valuation isn't necessarily a driver. You need a catalyst to change it, frankly. And I don't see the catalyst to change the direction of the market in a serious way in the near term, unless, of course, two things happen. One is the pending vaccines are proven to be ineffective or have detrimental side effects that are not tolerable. That would be, I think, surely a big setback for the markets, credit markets and equity markets alike. Furthermore, if the outcome of the Georgia election elects a Senate that is Democratic, I think the equity market may not like that too well because of what you were describing, Faisal, is the likelihood in that case of a pretty significant tax increase on corporations, which would cut their earnings per share prospectively, and the market would have to discount that. But absent those two things, I think the market is going to continue to do well. The backdrop of extraordinarily easy monetary policy, which you already described in your opening comments, is going to continue. The Fed has committed to not raising rates to 2023. Personally, I think by the end of next year, if the vaccines go well, they're going to be on the hot seat because they could have an economy that's nearly booming in the United States, frankly, and inflation expectations rising, and they're sitting on their hands doing nothing. I can see higher rates in the long end, a steeper yield curve in that environment. But that would be pretty good for certain parts of the equity market, though, including banks and value stocks. That would suggest. So, I think that if you have a strong economy, which is likely with the vaccines, if you have central banks that will unusually remain easy in that environment, as they've promised, fiscal tightening, which is not going to happen under a Biden administration, they're still going to be arguing for fiscal stimulus. Where is the catalyst for change? I don't see it, frankly.
You touched up on the topic of value stocks doing better. So we've known this year that after March, so let's say around March when the market bottomed, the ones that were survivors right after that on short term were the ones that were the stay-at-home stocks or whatnot. Following which, what we saw after the announcement of the vaccine, we saw value stocks rally, and we saw stay-at-home stocks or the leisure, the hospitality, the travel, the airlines. We saw those rally as well. Is that sustainable in its form, or is it just a recovery? Because we're seeing positive numbers in those sectors, industries, and whatnot, but they're still in recovery mode. Is it really a rally, or is it just recovery, a reversion to mean?
I think in those sectors you named specifically, it probably will not be sustained for long. I think that's very much like what happened after the financial crisis. After it was viewed that the banks were not going to go bankrupt, they were going to be saved. Their stocks, which were in many cases lottery tickets, $3, $4, $5 a share, recovered to, well, we're not going bankrupt. But that did not mean or put banks in a long-term positive trajectory in the equity markets for the last decade, and they've been big laggards. So there was an initial recovery. I think you can make an analogy to the airlines and the cruise lines in that regard here. Most of these companies have poor balance sheets, need a lot of recovery, have a lot of debt, and I think that the market will recover, and their stocks already have, reflecting likely not a bankruptcy, but sustained prosperity is another question. I think that it's more likely that value will outperform, but not on a sustained basis in those sectors, but in companies that have strong balance sheets, good prospects, and more stable earnings, but have been hindered by the lockdowns, the pandemic, and the like, and maybe even the very low interest rates. So I think things like banking might be interesting, as I think the economy reopens and demand for credit increases, and frankly, we see a steeper yield curve, and that would be very good. And these companies have generally very good balance sheets, at least in the United States. So I think your point about recovery versus sustained prosperity is an important distinction that we would make. But keep in mind that the U.S. manufacturing sector and globally, frankly, is already very strong. Most manufacturers are behind. Inventories are light. They haven't even caught up with demand yet. So you're going to have a continuation. Even now, we're seeing no lockdowns in manufacturing for the most part. A continuation of the strength of global manufacturing, coupled with, if the vaccines are successful, a reopening of the service economy. And I think there's tremendous pent-up demand for service activities, vacations, travel, even business travel, uh, going to restaurants, going shopping, going and doing things that you are clearly prohibited or are afraid to do today. And I think there's tremendous pent-up demand for that. And frankly, if you have strong manufacturing, strong service economy, and then a Fed and a central bank that's not going to be doing much, guess what? It's going to be a pretty boomy year.
Well, looking at companies with depressed balance sheets and looking at the high yield market and the Fed's support for the high yield market recently by dropping rates to zero, are we to expect defaults to slowly creep up? We really didn't see them creep up as the Fed was raising interest rates all the way to about 2.25, 2.5, and we didn't see that high rate of defaults right now. Well, that's one of the problems that I was worried about, and I talked about in the introduction. Is this a problem that's going to be kicked down the road? Is this a problem? And we know the energy sector is a big component of the high yield market. We also know we're seeing other sectors being participants in the high yield market, whether it's consumer related and the other. So is this a problem that's going to be kicked down the road? Do they have the financing now? Will the rug be pulled from under them later on down the future?
Well, right now, given liquidity conditions, most companies are able to refinance. We've seen cruise lines get financing after financing, airlines get financing after financing. There have been obviously a lot of bankruptcies in the U.S. in the energy sector. I mean, there are a lot of small companies, fracking companies had poor balance sheets, negative cash flow even before the pandemic. Okay, and then the pandemic struck, and essentially we have all sorts of restructurings and consolidation going on there. But eventually that'll mean less supply, particularly with potentially a Biden administration restricting, drilling in certain places. So I think the prospect of bankruptcies increasing a lot prospectively is lessened by the fact that the economy is going to get better, and we're not likely to see high real rates for quite some time. In fact, real rates may become more negative as the economy improves, but yet the Fed does not raise rates. So I think we are kicking the can down the road because if you look at the three entities that borrow money broadly, governments, corporations, and consumers, at least in the US, I would say, obviously government entities are in tough shape with respect to borrowing, including the US government, which has now, borrowed more money per capita than any country in the world during the post-pandemic environment. And frankly, corporations have borrowed a lot of money, although some of it has been to pre-fund their maturities and to establish war chests because they didn't know how long the pandemic was going to last. But still, even before the pandemic, their leverage was rising in the U.S. But yet, oddly enough, the consumer is in excellent shape, and they delevered for the last decade, and they have lots of positive attributes, high savings. Most people are unaware that personal income is higher now than it was at the beginning of the year,
Wow.
despite the unemployment. And that's why spending hasn't collapsed in the US. And it's because we've cut the unemployment rate in half and wages are growing at a healthy clip. So there's plenty of income. There's continued drop in the unemployment rate. By the way, asset values are much higher, so their net worth. And for most Americans, the most important asset is their house. And I didn't talk about it much, but that's probably one of the hottest areas of the US economy. So frankly, they're feeling pretty good about things. So I think investing in areas that the consumer is participating in, particularly, let's say, the mortgage sector in the US, is pretty good still.
Consumer debt as well. So
Precisely.
it did take a hit during COVID.
The interesting thing is the securities took a hit. It underperformed corporate debt by a lot, but yet the consumer is fundamentally the best poised to recovery, in my view, in many respects.
Now, Ken, if looking at the U.S. capital markets, where would you allocate to? Again, back to the discussion and the argument that valuations are very high, both in equity and fixed income markets. Being a foreign investor or an international investor looking at the U.S. market, where would you deploy to? Are there pockets or are there big opportunities that are still available? Or would you look across the pond for opportunities?
Well, one thing I haven't talked about and is a consideration is that I am and have been a believer that the dollar is going to continue to weaken in this environment where we have a deteriorating fiscal backdrop coupled with very poor and declining real yields to support that fiscal deficit, very easy monetary policy.
Well, the
And
interest rate differential has been all but wiped away because of the COVID thing. So we were much higher than that, and now we're equal to other central banks in the world.
yeah, I mean, the interest rate differentials have collapsed. I think that was what was supporting the dollar, frankly, because the fiscal backdrop was already bad for the last few years, but the interest rate differentials were so strong, it still attracted capital to the US. But now that has collapsed, as you point out, and frankly, I think that it's interesting because the US markets have outperformed, but they've partly outperformed because of the nature of the US economy being very tech oriented and growth oriented. The big stocks have dominated the indices, they're growth stocks, stay at home stocks. Whereas in Europe and some of the emerging market countries, they've underperformed, but frankly, they've underperformed because they're more value oriented sectors. Their economies are more involved in cyclical sectors or banking, like in Europe, which have not performed. And as we get the vaccines, the global economy opens up, China's already doing well. If the value sort of rotation continues, and I think if it starts, it may keep going for years, that will allow, I think, some of these other regions to catch up. And with that weak dollar, I do think international investing, or let's put it this way, some of your domestic markets may do better. And I think that's true in Europe and elsewhere. So I do like investing outside the US in this environment. Within the US, I would say that I still think the value sort of opportunity in equities is still there. And as I said, I made a distinction between these initial recovery stocks that are not going to go bankrupt necessarily, but to a sustained value type of trade, which I think is more reflective of a strong balance sheet and durable earnings from value companies rather than these airlines and cruise lines. So I think that's still an opportunity. In fixed income, credit is very expensive. Investment grade corporate indices are around 100 basis points, near the lows that we saw pre-pandemic. High yield is not too far behind, yet treasuries are much lower, so the yields are much lower. I don't see bad things happening, but I don't see how you make a lot of money either. So I think that's interesting. There are some asset classes that I think are a little more interesting in fixed income. If you have the interest in some of the securitized credit markets, which are less followed, more fragmented, have not recovered as much. And as I said earlier, I think the consumer is in great shape. Another less followed market, but I think important in terms of diversification, but also returns, is some of the ILS space, insurance-linked security space. Our strategies are producing nearly 9% returns this year, and I think that's widely what the market is. In an environment where it's as high, if not higher than fixed income, in a good year for fixed income. And by the way, in a bad year for hurricanes and wildfires, and the sector still produces nearly 9% returns. And it's one of the few sectors I would point out that has gotten cheaper, not richer, during the last few years because of all the prior losses of hurricanes and wildfires and earthquakes in Japan and elsewhere. The capital has left the space, driving up premiums and yields and returns available to investors, whereas every other fixed income sector has seen spreads tighter and yields lower. So this is one that there's still an opportunity, good diversification, and I think some discounting of bad news already priced in.
And focusing on the point of a cheaper dollar, how do you think that will influence emerging market debt? Do you see it as an opportunity for emerging market debt to really come out with strong performance in the coming years?
I'll put it this way. In the funds I run, I'm overweighted. I like it because I think that's going to be a wind at our back, the currencies. Even though, the bond yields are not particularly cheap compared to history, but what is? But I do think the currencies are very attractive in some cases. Now, I would say, though, in Asia, in some countries in Asia we're involved, the real yields are still pretty attractive, frankly. And I think better fiscal policy, some countries, including China, has not really borrowed a ton of money. Their fiscal stimulus was more targeted and modest. And frankly, yields are over 3% there. So I think you can look overseas in some markets, particularly in Asia and elsewhere, where you can still get positive real yields and perhaps a more stable currency versus the dollar than you might see going forward. Furthermore, with the global economy starting to get back on track, the things that emerging markets produce will be in higher demand, hopefully even oil for your region, notwithstanding the climatists among us. But if you've noticed, I'm sure you have, just about every sort of commodity has risen in price: iron ore, aluminum, zinc, copper, all of it. And sort of suggesting global growth, but also suggesting maybe a weak dollar. So I think things are in sync that way.
And in terms of, and just one more note on the dollar and versus other currencies. With regards to emerging market debt, do you prefer dollar debt or do you prefer local currency debt in emerging markets? Do you prefer government or emerging market corporates?
Our focus has been on sovereign local currency credit at the moment, given that a lot of our idea is on the currency side, and a lot of these countries have managed their finances pretty well, and real yields look pretty attractive. So we're very focused right now on some of the sovereign credit that's available at pretty good real yields, and local currencies that have not participated over the last few years. With the Fed easy, it takes the pressure off. With the ECB easy, it takes the pressure off. And I don't see that changing anytime too soon.
Now, you touched upon the topic of commodities. We already have a couple of questions with regards to the commodity prices and the outlook for commodity prices. Is the main driver for commodity prices moving up being demand for those commodities, or is it just influenced with a cheaper dollar?
It's hard to untangle it all, to be frank, Faisal, but I think it's a combination of things. But I do think it's mainly related to growth, because if you look at what's happened over the last decade, there's been very little investment in commodities. You know, they've been so weak for so long. We're not developing too many more copper mines or aluminum extrusion plants or anything like that, frankly. So eventually that catches up. At the same time, we've seen growth in China pick up a lot. We're seeing manufacturing in the US, I would say fairly robust without any pullback because inventories are light. Even auto sales are strong in the US, housing is strong. So I would suggest that this is related mostly to growth, frankly.
Okay. And the number one commodity that we follow over here is oil, being from oil exporting economies. What is your view on oil? And I believe we have a few panelists as well that do have their different views on oil. So with regards to Amundi is how you play oil on an international level. We also have Lubomir here, who actually has a good insight on how we view oil as an opportunity within the GCC. Maybe you can start off. I believe Connor, you have a couple of notes on oil.
Sure. Thank you, Faisal, for the invitation to be involved. Very pleased to be here and happy to give a few thoughts on oil. You spoke about demand just now. For me, into 2021, the oil story is much more demand driven than it had been over 2020, where the focus was much more so on supply restraint in the face of demand destruction, but dealing with supply on the back of that demand destruction. For 2021, I think the focus is heavily on the demand side. My expectation is that we see oil price average $50 a barrel, Brent, over 2021. This is probably at the low end of consensus. Relative to consensus, I expect structural impacts on mobility to remain around business travel, international travel, related to...
Is this on the expectation for rising oil demand, or is it for so are we expecting oil demand to rise, or will this be actual oil demand rising in the first half of 2021?
I see oil demand rising, but not necessarily in the first half of 2021. Q4 2020 has been very weak. I expect it to remain weak into Q1 2021 and even into Q2 2021, depending on the rate of the vaccine. My expectation is oil price, based on weak demand, will remain well below 50, or certainly below, but possibly well below for the first half, and that into the second half, as demand comes back, as mobility improves based on vaccine rollout, that demand will come back, and that over the second half Brent can breach 50 and remain above it. But certainly into Q1 and Q2, I don't see any material change to demand dynamics. We're seeing continued rolling lockdown measures in Europe and in the US. And although we have a lot of positivity around the vaccine, I don't expect it to impact global mobility for some time. I think mobility is a key point here in terms of how long people spend traveling, how long people spend commuting. It's directly linked to gasoline demand, and I expect there'll be structural impacts even post a vaccine rollout in terms of people's patterns working from home and commuting. The figure I have is that about a third of miles driven in the US and Europe relate directly to commuting miles. If we have an impact there which can last, we can see sort of weaker demand than we would have seen in the past. And also in terms of international travel, I think the vaccine rollout is not going to happen equally across different regions. We've seen already developed markets have bought up more of the vaccine availability than emerging markets, which means we're likely to see ongoing constraints on travel from one market to another due to different levels of proliferation in the virus in those countries. So although we should see demand coming back, I would not expect us to get back above pre-pandemic levels of gasoline demand over the next 12 months. I think it's possible in the middle of 2022 or so, depending on how successful the vaccine rollout is and how those structural impacts on mobility play out. But certainly at the end of next year, I expect demand to be quite a bit stronger than current levels, but to remain materially below 2019 levels.
What would be the impact of a disrupted supply picture with increased supply of oil coming into the market to your projection?
Sure. So for the moment into next year, I don't expect us to see anything like the oil price volatility that we saw over last year. I think OPEC have very successfully acted as a swing producer this year, and I expect them to continue to be an effective swing producer into next year, absorbing variances in supply and demand in support of relative price stability. I think if we do see a surprise to the upside in production, for example, additional barrels coming online out of Iran or further supply out of Libya or any other production upsides, my expectation is that OPEC will be in a position, or will certainly seek to delay their own scheduled production increases or even make additional cuts to seek to balance that out. The world has seen how oil markets operate without an effective swing producer, and I think interests have been aligned by the volatility we saw last year towards keeping OPEC in place as an effective swing producer, and that's my expectation, that they will be in a position to do that into next year. Even based on the OPEC meeting last week, it's very clear that although they adjusted their output increase schedule, they're very focused on demand and demand growth, and that if we see demand coming back weaker or supply coming back online stronger than expected, that they can tweak their scheduled output growth. So I expect ongoing management of market equilibrium by OPEC, and I think they've said officially they don't have a plan in place to deal with Libyan barrels if they do come back online, but with quite material cuts in place and the principle in place that they'll seek to manage excess supply or demand based on delaying their own cuts, that is how I expect additional Libyan barrels, for example, to be dealt with.
Now, Luba, in terms of a regional investor's perspective, how does your team view the energy market from a regional perspective, from regional investors' perspective? Are we seeing what Connor's saying be reflected in regional equity markets, especially in the energy sector?
Well, I think in terms of expectations, we're pretty much in line. So from my side, I'm really looking at oil in the sort of mid 40s to mid 50s kind of range. So significantly less volatility than we've seen in the past. However, on a longer term sort of time horizon, we are seeing sort of a shift away from oil. So 2019 was the slowest increase in oil demand, and this is pre-pandemic. So I think if we're targeting kind of a return to pre-pandemic levels by the end of 2021, that's still quite a ways off from where the regional economies really need the price to be. So I think regional economies will face their own issues, probably from the fiscal side, and some of them have enacted reforms to try and tackle this. So obviously, Saudi's the most recent and kind of the most aggressive plan at the moment in terms of timeline. They've been very active on the bond market with international issuances in dollar and euro, and I think it's a smart way to go at the moment. Kuwait has obviously lagged because they still need to pass the debt law, similar to the situation that the US had with the debt ceiling. So I think regionally it's quite a difficult situation. The local listed equity players didn't really correct. So once the pandemic hit and we had weak spreads and product prices, a lot of these players did not correct as we expected. And in fact, the materials and petchem space has pretty much outperformed the regional markets. And
even with prices being so low.
yes. And actually what we're seeing now is investor appetite is still there, and they're chasing the sort of short-term Q-on-Q recoveries from a low base, right? So where you had a lot of the big names posting record losses, they're swinging into the black again, and the demand is still there from the retail investors. So those valuations definitely look pretty stretched at the moment, but there's no sign of an easing of investor appetite for those.
Now, Luba, we talk about this all the time, and one of the topics we talk about is that the energy sector right now does not comprise a lot of any of the global indices. So they've shrunk from anywhere between 20% representation in global indices down to single digits. Do you believe that there's going to be a breath of fresh air blown into the sector in the form of alternative energy, or in the form of alternative energy or clean energy? Are we going to see that kind of investment here in the region?
I think we've started to see a little bit of it. It's been happening on a much larger scale globally. So if you look at, for example, China, last year they led the world in terms of renewable deployment, and most of that went to producing domestic electricity. So this has been a very meaningful shift elsewhere. I think the region is still far behind, but we've seen some projects come online, particularly in UAE, and also Saudis starting to come through. So the region still relies heavily on oil and natural gas for their energy needs. Now, if you're an oil exporter, obviously it makes sense to keep as much of that product for export purposes rather than use it internally for your energy production. So from that side, meaningful investment in renewables and alternatives would free up additional export capacity for regional economies.
Now, Connor, same question goes to you, but on a global scale. Do you see the energy sector being revived by further contribution from alternative energy and clean energy? Are you seeing that happening right now?
We are seeing CapEx budgets being increasingly allocated towards cleaner forms of energy, and certainly more particularly being reduced in towards dirtier forms like coal, for example. The regulation around this continues to develop, like even referring to the US Biden administration thoughts around gas, the perceived carbon intensity of gas relative to coal. The regulation is still catching up around this, so there is still shifts in terms of what's considered clean energy or not going forward. But certainly, particularly as companies are seeking to publicize their efforts on the ESG side, and they're seeking to publicize their efforts to be part of rather than left behind in the energy transition, we're seeing an increasing focus on allocating capital towards cleaner budgets. It's still, I would say, a small percentage of CapEx budgets for certainly the oil and gas companies that I would look at. On the EM side, it's probably a more advanced trend on the DM side. Certainly on the EM side, it's in early stages, but it is beginning.
But on EM side, isn't China, or can China be the catalyst in terms of demand for such alternative energy? Will their growth, a part of their growth, be tied up to that, or is it too soon?
Yes, but it's not. It's not currently financed through the oil companies that we would look at in the regions. They tend to be coming from separate SOE buckets, but certainly China has massively expanded its renewable capacity in the region. It just hasn't come through. I mean, for us on the bond side, Chinese E&P producers aren't a big component of the index, so it's less representative, I would say, of the index than it is representative of for example, China's contribution to renewable energy capacity. It just hasn't been a big component of, for example, the index on the EM bond side.
And maybe Lutfi, since you have a good view on where investors here in the region are deploying money to, are you seeing them deploy towards conventional energy, or are you seeing them more and more deploy towards ESG and alternative energy?
First of all, thanks for having us again, Faisal. It's a pleasure to be here. So yes, indeed, ESG notably has been, I would say, one of the key themes this year. I would say that ESG strategies overall, they had already a very strong momentum, but it has been reinforced in the context of the COVID crisis, with investors being probably more sensitive to environment, social, and equality issues, really. So I would say that the COVID was a bit of a wake-up call, in a way, on things that truly matters, which is basically our planet and the people. And on a regional basis, we've seen a lot of activities on ESG, especially from Europe, which has been leading the charge, for sure, but followed as well by the US and in Asia, where we're seeing an increasing momentum for ESG strategies. I would mention for the Middle East that actually ESG is not a new concept. If you look at Sharia products, they do share a lot of similarities and goals with, let's say, sustainable investment. So there is also in our region, because we always perceived, as you know, Faisal, as the region really much depend on oil, and we all investors tend to think that the Middle East would follow maybe later than developed countries, but actually we have in our region, sovereign wealth funds joining forces with their peers to tackle climate change issues, which is really promising. So there is this year a big momentum into ESG strategies. I would say it's both a retail but also institutional story. Especially in Europe, we've seen an increasing number of RFPs and demands with, let's say, pension funds, corporates, and all institutions integrating ESG constraints into their guidelines. So this is really much of a strong momentum, also performance. I should mention performance at the end of the day has been good versus let's say more traditional assets. Especially this year in the context of the COVID, ESG strategies, they do have structurally an overweight exposure to sectors like healthcare or new tech, and also underweight to sectors like materials, energy, and transport, who actually have been hit this year. So performance was good for ESG strategies, and clearly we see a trend. To answer your question, there was an underlying trend. We do believe that the trend is going to continue. It's not some kind of fashion trends. In Amundi, we've been involved for a very long time in ESG, and then we are planning actually to have all our open-ended funds following let's say an ESG approach next year, and probably a lot of other asset managers will follow suit in their own way, with their own philosophy and perspective. But clearly we do believe that ESG strategies would be the new mainstream in the years to come, really.
So these types of investments do not solely focus on a good carbon footprint or a low carbon footprint. It's also in terms of social governance and as well as corporate governance. So maybe you can highlight a little bit of the benefits of being in an ESG strategy in terms of balance sheet perspective, in terms of a conservative perspective for companies. These companies tend to not have higher debt. Is it similar to the Sharia compliant in that sense, or is it totally not the same?
Now, we do have, I would say, we do, we have large resources in terms of research. So again, we've done a lot of work. So most of the time, how I would say asset managers approach ESG. So most of the time, they would start with an exclusion approach, right? So you would exclude some sectors from your universe, let's say
Alcohol,
coal or tobacco.
and oil, right?
Absolutely.
Okay.
Exactly. So that would be one building block. Another way to approach that, Faisal, would be, to implement, I would say, more sophisticated approach, which is basically best in class approach, where obviously you need to have resources, you need to have an investment process, an investment approach. So on our side, we've been developing, I would say, a structured investment process for years now, and we were among the pioneers into ESG. So we rely on 14 analysts in ESG doing the work for us, but we also work with partners feeding us with a rating on issuers. I think we're following pretty much 10,000 of issuers. We rate 10,000 of issuers at the moment. So there's a strong disciplined process into that. And if you move again further along, you also have what we call the thematic strategies, where clients also give us, let's say, guidelines in terms of what they're looking at in terms of, let's say, renewable impact strategies, which are becoming more and more important. How do you measure that, and so on and so forth. So depending on, so this is the way we approach it, but depending on the way we work with our clients, depending on their request, we use the various building blocks really into our investment approach.
Excellent. Now, gentlemen, I think we're running out of time here, but maybe if somebody wants to contribute with any points, I have a question for Ken, if I may, before we end this.
Sure.
You have $100 million. Which parts of the world would you look at? So if you would allocate it in terms of geography and then allocate it in terms of asset class, if you could run that exercise for me, I'd really appreciate it.
Okay. Well, I still think that stocks, particularly in certain types of stocks, are still cheaper than fixed income. If you look at simple metrics, earnings yields are still historically high relative to bond yields, or particularly corporate bond yields, which are now trading at really record low levels. Of course, there are parts of the equity market that are very expensive, but I think that if I were putting together a portfolio, I would still have it 60, 70% in equities, particularly value equities. And I may overweight, from a historical perspective, some non-dollar asset classes in equities, particularly on the value side in Europe. Emerging markets would be interesting to me as well.
Will it include energy?
Excuse me?
Will it include energy stocks?
I think as the global economy gets better, there's an opportunity for short-term, over the next year or two, gains in energy. Just thinking about it from a market perspective, not a climate change perspective, or putting any value judgment on it, but just the math and positioning. I think ESG has become so popular that it's a little bit of a vicious cycle for energy, that the more ESG has gotten adopted, the more liquidations and divestitures we've had of energy stocks. And even though it's a very low weight, I think that investors are very, very underweight energy, frankly, traditional energy companies. And there may be a little bit of an opportunity as the global economy gets better, frankly. And even though it may be a slow recovery over the next quarter or two as the vaccine gets rolled out, I personally think by the end of the second half of next year, it's going to be a little bit, as we say in the U.S., a barn burner, because I think people are dying to get in their cars and drive and go someplace and fly somewhere. And even on business, what we have noticed, what I have noticed, and what we talk about in our business, by the way, because I'm on our executive committee, is that, frankly, in this environment, it's not so hard if you have good performance and service to maintain your clients, but it's more difficult to gain new clients and new business, because at the end of the day, people want to see you and talk to you and have a long conversation with you, and it's difficult on Zoom. And I don't think that this is only true of, frankly, asset management. I think this is true globally. I was reading a very long article from the CEO of Schneider Electric over the weekend. It was in the Wall Street Journal. He was saying the same thing, and he doesn't have anything to do with asset management. So I think there's a lot of pent up demand for travel, and we'll see about those demand estimates. I could see it taking a little time to get off the ground, so to speak, but I think by the latter part of next year, there's going to be a lot of demand, and maybe there is an opportunity. And by the way, these stocks are now moving already, by the way. They've become some of the better performers. So we'll see there. That's possible. Longer term, in fixed income, I still think you need some treasuries for liquidity or some government bonds, although I do think treasuries are cheaper than European sovereign bonds, although the currency is a little bit of a question mark. But I think you can get currency diversity through your equity holdings. Furthermore, I've been at this for more than 30 years, and I've really never, ever considered or recommended or personally invested in gold. But now I'm thinking about it. And it strikes me that, number one, the obvious, with low rates or negative yields, the traditional cost to carry an argument against gold is it's very expensive to hold. Well, if you're a European, it's actually positive carry because short rates are negative. And even in the US now, rates have collapsed. And the argument, this whole modern monetary theory thing that's flying around and being discussed, being given academic credence, in my view, and maybe not whole hog adopted by central banks. I think it's influencing their behavior somewhat. And this idea of fiscal spending without limit, or pretty much without limit, monetary policy pegged at zero for as far as you can see, despite what may happen on growth. I just wonder, does anybody really care about their currency, and does fixed income preserve capital or provide income like it used to? I just wonder about that. In fact, in Europe and the US, if you buy a treasury or even most corporate bonds, you're not preserving your capital. Inflation is already, by the way, I don't know if you've noticed, TIPS have outperformed dramatically in the last 6 months. They collapsed in the initial pandemic outbreak in March and April, but now long 30-year TIPS, their break evens are approaching 2%, okay? Higher than pre-pandemic. And we still in the middle of the pandemic in theory. So I just wonder about some allocation there, 5%, 10% as well. So maybe 20% or so towards liquidity, treasuries or something like that, 10% gold, and maybe the rest in some equities, diversified in value particularly.
Final question, and on that note, and it's probably off grid to what we've been talking about, is the topic of cryptocurrencies and Bitcoin, and there's a lot of discussion on the performance of Bitcoin during the pandemic and during the crisis. Do you have any thoughts on that? Is Amundi an institution that would look into this technology, blockchain technology, or investments in blockchain technology and cryptocurrencies?
Yeah, I'm not sure I can speak for the whole organization of what investments we've made in blockchain technology, but I don't see us as of yet investing in product or people or systems to accommodate trading and investing in Bitcoin quite yet. Me personally, I still think that it's a little bit early in the game from a fiduciary perspective, given a lot of the uncertainties about that as a median exchange, safety, given all the cyber risks. So I think it has some time to go, but we'll see. I say the jury's out, and I don't think I can speak for the whole organization on that one, I'm afraid, Faisal.
All right, gentlemen, I think we've reached the last bit of time, so we're quite run up on time. But in closing, I would like to thank our panelists for their kind contributions and thoughtful insight. I would also like to thank our guests for making their time so late in the evening to attend this webinar. We're certainly embarking on a period of uncertainty as markets are reaching metrics never before seen in history, or in modern history at least. Will it be a continuation of current trends, or will ones avail themselves quite soon? questions we would like to leave you with is that we hope you will consider the following. What can we do to protect our portfolios? Are there still clear opportunities that can be pursued in the coming periods of uncertainty? What are some of the risks that investors should be aware of as they continue to navigate the market well into 2021 globally? I hope that we were able to shed some light on the answers to these questions. Kamco Invest and its partners are always prepared to assist their clients in making sure that they always make a well-informed decision in any market environment. Gentlemen, thank you so much for your contribution. Thank you so much for making it here, and we really appreciate your time.
You're welcome. Have a nice evening. Thank you very much.
Thank you.
Bye.
Thank you, Faisal. Thank
Thank
you,
you.
everyone. Cheers.
Thank you.
Thank
Good
you.
night.
Bye.